Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey Fleck and Chad Markowitz here, your hosts for this weekend show. Thank you all for joining us on this weekend show. We're going to start off by more discussing the market's big picture, talking about a bit of a rotation trade, and also touch on the commodities. On the back half of the show, we're going to switch our focus to the energy sector, more specifically oil and natural gas, which continue to trend downwards, trying to find a bottom or where that bottom might be and where some good entry positions might be for a couple equities. To kick off the show, we're chatting with Mike Larson. Mike is the editor-in-chief at MoneyShow. He is featured at all the MoneyShow conferences, and I recommend clicking on the link in the show notes to find out where the next conference is and follow up with Mike to see who the speakers are and hopefully join that conference. Mike, a big theme, I guess, in these markets being that the markets have been melting higher. This last week showed a little weakness for the markets, but broadly, it's been a bit maybe slower the last few weeks and last month, but markets still have a bias to the upside. And we've seen some of the lagging sectors start to maybe play a little catch up. Wondering if you've noticed that as well and what the key themes are that you've seen really over the last month or two within these markets.
Yeah, of course. Absolutely. Glad you guys had me on the show. You know, it's interesting, this rotational action we're seeing. I mean, first off, let's stipulate that this is the dog days of August. We're in kind of a slow period. Probably half of Wall Street's out in the Hamptons partying it up. So it is, you know, it's you don't want to read too much into what happens at this part of the trading year. August and September, of course, also are historically two of the weakest months, with September being the worst. So, you know, you tend to see some odd action when you have thinner markets overall, and this tends to be a rough patch, historically speaking, during the average calendar year for the U.S. stock market. That being said, you're definitely seeing rotation. I mean, really since the beginning of August, I kind of jokingly said it was the out of Palantir into Pampers market. And by that, you know, everything that was super red hot, the AI plays, the Palantir technologies, the QQQs, the Metas, and so on, all of those stocks have pulled back, you know, relatively notably, although after being up for quite some time and putting up tons of points. And instead, you've seen money kind of rotating out of that into more defensive things, healthcare, consumer staples. Pampers, of course, is Procter & Gamble. They make that diaper brand, so Procter & Gamble stocks picked up. It's just an example of again, people maybe taking some profits on winners, looking for something a little more defensive. And I think part of that probably stems from a couple of different things. One is concern about the Fed. You know, we're in the situation where, as we're recording this, Jackson Hole Powell's speech is going to be tomorrow. On Friday, we'll see what he has to say. He can probably either lay the groundwork for a September cut or push back against Wall Street's kind of big expectation that is going to be a September cut. So that's one thing I think markets are kind of, trying to, suss out what's going to happen with the Fed. Obviously, there's other turmoil. There's more political pressure from the Trump administration on the Fed. They're now talking about trying to get another Fed governor thrown out for some alleged mortgage-related stuff going on. So, that political pressure, interference, whatever you want to call it, on the Fed does sometimes, give the market a little reason for pause, kind of bad for equities, and also gives you a little bit of a, bond sell-off at the long end of the yield curve. So you're seeing that, that sort of hinder the market a little bit. And then finally, I would say there's questions about consumer strength and AI strength. I mean, one of the reasons Palantir sold off, there was a short seller report that came out and kind of questioned its valuation and some other things. Then, this week we had news that Meta Platforms, which has been throwing, billions and billions of dollars at the AI engineers and AI experts to build out that team. Now, reportedly, they're having a hiring freeze there because it costs so much. That just gives people an excuse to take profits in what's been working really well. And lastly, questions about the U.S. consumer. I mean, Walmart missed earnings expectations for probably the first time. I think it was the first time in 3 years. Target's numbers were relatively lousy. I mean, Target's faced other challenges, so that's somewhat company specific. But even some of the other retail reports that we got, they just weren't all that inspiring or exciting this week. So there is some concern about, what does that say about the U.S. labor market? What does it say about consumer spending? People are a little concerned about that. So those are the things that are behind some of the action. Those are the things that have kind of prompted some profit taking. And it's really a question of, how much of it is just thin markets, how much of it is something you really need to be concerned about. And I don't think we'll know the answer to that question until, after Labor Day when desks start filling up again.
That's a great synopsis, Mike, and a lot of different areas to dig into there. Just speaking of the look forward to September for the rate cut, yes, we will get more clarity tomorrow when Jerome Powell speaks in Jackson Hole. But in general, the market is pricing in a rate cut. And we have noticed over the last couple of months, ever since the April bottom, that the small caps, the IWM, have started creeping higher again. And so, to the point you made at the onset, this rotation, we've been talking about it as the laggard trade for a while. It seems like the last 2 years. But do you think that maybe some of these other laggard sectors are getting the bid simply because they just represent better value than some of the other valuations that are maybe a little more blown out to the upside?
Yeah, I mean, I think that's a great point. Let's be honest, if you measure from the April lows to maybe August 1st, I mean, some of the moves again, not just the Palantirs and Metas of the world, but a lot of companies, a lot of the big tech names and leaders have really been, I mean, they've been putting up gobs of points. So you get to a situation where there's some question about the Fed, there's some question about growth. You're a portfolio manager, you're a big money investor, and you're saying, I got to take something off the table. I'd be stupid not to. So yeah, I think some of that is just looking for those new winners. I think it's worth noting that rotational action is not bearish overall. I mean, if you're a bull on the stock market, you don't want 10 stocks going up every day and the other 490 in the S&P or, roughly speaking, not doing much of anything or losing ground. So I think that that broadening out that rotation is actually a good thing as long as it doesn't turn into this super heavy rotation into everything defensive. If I turn on my screens in the morning and start seeing Procter and Gamble going up every day, and I see Clorox going up every day, and I see some of these other defensive type names going up every day, and Treasury yields falling, and the SPY going down, then you start to say, geez, is this a pre-recessionary trade versus just rotation? I'm not seeing that. I don't think that's the case. There's not, none of those sort of indicators that I look at are really, pointing to a worrisome action like that. So for now, I'll just call it rotation and say, look, it's a reminder of why you have to own more than just big tech in your portfolio if you're a long-term investor.
Mike, what do you take from some of this weakening, or let's just say broadly worse U.S. data we've seen? Jobs came in, not very good. That was a few weeks ago now. And then inflation last week was ticking stronger than expected, higher. So both kind of going against what the Fed and I think most citizens want.
Yeah, I mean, I would characterize the economic data as squishy. It's not the kind of pre-recessionary type stuff that I think I've seen at past major turning points where you go from sort of a bull to bear market and you really start worrying about growth. It's more, this tariff stuff, again, some people may like it. I personally think it's just causing concerns. It's hurting business confidence. It is helping to keep somewhat upward pressure on inflation. And all else being equal, it's something that keeps the Fed from cutting more deeply. On the other hand, you have things like the big, beautiful bill and tax cuts and regulation cuts that are helping in sectors like financials and so on. So I'd characterize it as sort of a squishy, more mixed bag bundle of economic news and data, as opposed to something that's like, geez, we're really driving ourselves off a cliff here, or geez, I'm seeing a lot of warning signs and yellow flags that tell me I want to get pretty defensive pretty fast. So, I mean, that can change. I'll be watching the same numbers as everybody else, but I don't, the things that I've typically seen or that have worried me at past major inflection points, I'm not seeing it out there right now.
Well, Mike, I think I asked you this last time, but I will just follow up again and let you unpack that point further. There's some people looking at the markets, and when they saw the revival of the meme stocks, or when they saw cryptocurrencies blasting to new highs, or you could argue that the IPO of Bullish, BLSH, when it's such a huge IPA with that ticker and that name, that it could be getting a little frothy, but you're saying it's not like what you saw in 2021. So maybe break down the distinction. While there are some pockets of maybe froth, it's not concerning to you.
Yeah, I mean, you're absolutely right to call some of that out. I mean, I did a podcast with a couple of guys, a guy from StockTwits, Blossom, a few others that are sort of in that social media active trader world and follow a lot of what people are saying online and trading tips. And even they said, I mean, that's sort of their bread and butter of who they follow and who they interact with. And even they said towards the end of July, it was getting a little silly, things were getting extended, and some of the smarter people that, the active traders that were on their X spaces and things like that, we're saying this is problematic and it's going to lead to a pullback. So yeah, I think it's fair to say we had some overheating and that's what we're working off here. Again, though, I don't think that the type of nuttiness. I mean, Chamath is out there, I guess, trying to start another SPAC, so maybe I'll eat my words. But I don't, I'm not seeing as many of the things that I saw in 21 that really kind of scared me or told me that we're going to be in trouble back then. So for now, healthy pullback, healthy rotation, the kind of thing you want to see in a bull market that has longer term legs. So, I think that, and frankly, maybe selling off into Powell is a good setup because almost no matter what he says, you've priced in a little bit of risk. And so if he just delivers a little bit of nice words and happy talk, then maybe we just rip from there.
Yeah, every pullback recently has been a great buying opportunity, but those pullbacks have been so shallow. And you made a comment there, Mike, about potential long-term bullish market. What do you think are some of the best long-term plays for those people that don't want to be trading and trying to readjust on a weekly or monthly basis? Is there anywhere that you see within these markets that you can just put your money and be pretty comfortable with?
Look, I mean, again, those higher dividend type names are great. I mean, in utilities, in some of the safety names, but I wouldn't go overboard. I mean, I do like some of the higher yielding energy type names. That's a good place to be. And I've been bullish and on the train when it comes to the miners and mining stocks. I don't see any reason to get off that. We've had this consolidation in gold for a few months now. And it's kind of interesting. Some of the people that I follow that know that that really do kind of bottoms up work in that space are saying this could be, setting the stage. You're sort of correcting in time, not price. This sets the stage for another leg up in gold. So precious metals and equities tied to that, I still love. And I think even financial sectors like that, again, there aren't big credit worries out there, in my opinion, at this point. There aren't big issues or sort of warning signs in the credit markets behind the scenes. So I would still say that sector probably holds some promise here.
Well, Mike, you brought up the precious metals, and our audience, a big resource investors, a lot of people in the resource stocks. And I think you made a great point that while gold has been correcting in time, which you'd much prefer over correcting in price, you've still seen a nice move in the gold equities. If you look at GDX, it's been blasting up to 52-week highs, and it's not at all-time highs, but it's definitely blazing a trail higher, even while we've seen a sideways action in the gold price. So how are you looking at something like the gold equities, or we could even throw the silver equities in there, same kind of pattern?
Yeah, I mean, again, you're absolutely right. That's a good point. I think what's happening is you've had people that are kind of getting dragged kicking and screaming into the space if they're sort of big money or generalist investors. They haven't been paying enough attention. I forget who shared the Bank of America fund manager survey the other day that showed like 41% of the fund managers polled had zero exposure to gold still. And this is after, one of the biggest couple, year and a half, 2 year bull runs we've had in a long time. So I think what's probably happening, again, when you look at sort of the total capitalization of the mining sector and other sectors like energy relative to tech and the S&P overall, I mean, it's hard to, when you're a big money manager, to get exposure to that because there isn't that much equity and capitalization out there. So when you start getting the Fidelities or whomever of the world buying into that sector because they realize they've been missing out, you see an outsized impact in how the stocks perform. And I think that's what's behind it. I think you're finally seeing more mainstream money, big money, non-sector specialists buy in. So that kind of leads to this, this sort of never ending. I mean, I don't want to even say never ending, but very powerful underlying bid that can send these stocks up day after day, week after week.
On that whole topic, the whole time I've been in this sector, Mike, people have been talking about other money coming into the sector, generalists, just a small amount that could move the sector, investors in crypto or investors in tech stocks. If they come into the sector, boy, oh boy, it would just blast off and re-rate everything. What would you watch for to show that is happening? Where do they come in? What sort of moves? What sort of equities? What ETFs? How could we tell if truly there is a maybe generational shift coming where other investors who have made money in other sectors finally come into the precious metals?
I mean, I think we're talking about what you'd look for right on the show, right as we're sitting here. I mean, if you look at a company like Newmont, which is obviously one of the biggest names in the space. I mean, it's the 6 month chart of that stock just shows never-ending accumulation, right? I mean, it's had little dips here and there, but it's going up pretty much every week. If you look at GDX or some of these, or some of these junior names, I mean, gosh, they've been just marching higher in a steady cadence. So I think that is what you would see to indicate, look, the 41% of those people in the Bank of America Big Fund survey that are sitting there without no gold exposure, and their investors are starting to call them up and say, what are you thinking, man? What are you missing out on? This is what you'd see. So I think that the action that's out there right now kind of tells you or kind of hints at, yes, that is what's happening.
Mike, when we broaden out the commodity sector to look at other things like oil and gas or copper or even some of the other base metals, while there's been some constructive moves in copper, there's been some tariff tantrums there too. Excitement on the front end and then disappointment on the back end of some of the tariffs. But in general, when you look at the commodity sector as a group, some of it is not as robust as the precious metals. The precious metals holding a unique spot in that they're kind of a hedge against financial chaos and geopolitical chaos. So maybe getting an extra bid from that, as well as a central bank bid in gold. But when you look at something like copper or oil or gas, maybe not as robust. So does that worry you at all about maybe an indicator of how the economy is doing?
I think you're right to point it out that when generalists just say, oh, commodities are going up, it's like, well, no, it's more nuanced than that. Like you said, energy stocks haven't been doing much for months. Copper has been buffeted, but first the big surge, then the big drop in the futures because of the tariff stuff. And yeah, those are economically sensitive parts of the commodities market, whereas obviously precious metals are more, tied, especially gold, to that sort of safety, currency protection, wealth protection bid. It doesn't mean per se, it doesn't mean that you can't find bargains in those other sectors, but yeah, if you're looking to trade momentum and shorter term gains, you're going to have more fun and more results in a sector like gold and gold mining. If you're looking for value and where can you find decent yields, good valuations, and potential kicker if the economy does sort of pick back up, then you look at something like energy. It really just depends on your style. I'm not in the camp that says, oh, oil's going to $40 and, copper is going to get cut in half because of a big global recession or anything like that. But I do tend to shade my enthusiasm more towards the precious metal side of the equation because I think that has more fundamental factors really arguing for higher prices at this time and probably for the foreseeable future.
Mike, let's just quickly touch on copper. I do want to get more into the energy sector, but copper, the last time we chatted was tail end of July before the tariff, I guess, clarity came down, and copper in a way kind of re-rated just a bit lower, dollar lower more so than where it was from, again, that tariff pop and the general uptrend that it's in. What's your thought on copper now, more trading around the 440, 450 level?
I think, the short-term shenanigans that happen that were tied to the difference or differentials in copper pricing in various global markets and how the tariffs are going to impact that and so on and so forth. You kind of have to just ignore, maybe lop out if you could take your charts, your charting tool and just cut out 3 weeks of trading activity and just look at the longer term picture, I think you'd still be pretty bullish. And I think at these levels, copper's got a lot going for it in terms of grid investment, in terms of energy demand, even EVs and some of the demand for that longer term. So I think that copper is probably another solid metal or play in the commodity space that you've worked out the short-term strong hands, weak hands, whatever you want to call it, and the people that are just trying to trade the next pop and drop. And now you're looking at from a long-term standpoint. I still think it's a relatively bullish metal that you can be playing in for, again, a multi-month, multi-year holding period as opposed to just a couple of weeks.
Well, let's go from the energy metal over to traditional energy. When you look at oil and nat gas a little more close up, they haven't been rocking and rolling like like we said, like the gold and silver. And actually, they've been in kind of a muted to pullback zone. So when you look at oil and nat gas pulling back, what's your take on the valuation as far as energy companies now? Are they at that more attractive by the dip spot, or are they in a void for you?
I think it's going to be kind of a longer period of watching paint dry there. I mean, I don't see any huge catalyst for an upsurge in energy prices, supply demand picture, what OPEC Plus is doing, what U.S. producers are doing. It doesn't, to me, argue for, geez, we're right on the cusp of a big rip or we're right on the cusp of a big decline. It's more of a snoozer kind of section within commodities. So if you're going to play in that area, I think you want to focus on some of the higher yielding names, the MLP type stocks, companies that are going to, pay you to wait, basically. And again, because I don't think it's going to be a situation where we're going to wake up and oil is going to be $45 instead of the low 60s or whatever. I think we're kind of in a good home base here. But at the same time, I don't think we're going to wake up and see $90 oil either.
What do you think about so much of the focus for natural gas being on these LNG terminals and how much extra demand, how it could really disrupt the market, albeit we've been hearing about this for well over a year now, but they're starting to come online. Do you see these LNG terminals as really the big growth that a lot of the at least nat gas bulls are pointing to?
Yeah, I mean, it's a great long-term story that I think is probably accurate. I mean, one of our smartest energy speakers, Anas Alhaji from Energy Outlook, whenever we have him on the podcast, tens of thousands of people watch the YouTube video because he's got a global audience. He's very well received at our events, and he knows this stuff inside and out. And I think within the energy sector, he has pointed out that U.S. LNG or demand for U.S. LNG from overseas buyers long term is definitely going to be a force that probably argues for that part of the energy market having longer term promise. So yeah, I mean, I think it is. It's not just a story that is interesting. It's a story that's accurate, in my opinion.
Well, Mike, while we're talking energy, let's bring nuclear into the mix here. Earlier, we've seen some from the Trump administration earlier in the year, some executive orders, four different executive orders that dealt with the nuclear power, enrichment of uranium fuels, and even supporting the domestic uranium markets. And we saw a big rip higher in some of the small modular reactor stocks, things like NuScale Power and Nano Nuclear and Oklo just shot up multifold. And they've cooled their jets a little bit over the last month or two, as has the uranium space. So while there's a lot of fundamentals under the surface positive for nuclear power, the sector has started to correct after a pretty big rip. Any thoughts from any of the guests on the Money Show, or any thoughts on nuclear or uranium?
I'm certainly not a specialist in that kind of subsector of a market overall, so I can't really speak from any personal experience there. I will say, when I talk to people like Sean Broderick, obviously you have him on the show, he knows subsectors like that better than I do, and he still thinks that we've got a pretty good long-term story there. So I think, again, not from my own opinion because I'm not an expert at all in that part of the commodities market, but from people that I know and listen to that are, still think the long-term story there is positive.
Let's also go to cryptos because Bitcoin made a run to a little over 120,000 and has pulled back since. But a lot of people have noticed Ethereum outperforming. A lot of money has gone into Ethereum, and there have been some of these other coins that always seem to get attention here and there. It's mostly marketing around those things. But the outperformance of Ethereum compared to Bitcoin and Bitcoin's recent breakout, what do you take from that?
I think from what I do know and from people I listen to, Ethereum has better sort of use case or potential and a lot more things being done that could ultimately help drive demand for that particular cryptocurrency higher and prices up over time. So, if I have to invest in the crypto space or a cryptocurrency that probably has more upside potential than others that are more mainstream like Bitcoin, I mean, Ethereum's still mainstream, don't get me wrong, but I think yes, I would. It's almost like I kind of look at it as almost like gold and silver. There are times when you think that the gold silver ratio and silver lagging when gold's up, that the momentum is going to shift and the profit potential is higher in silver vis-a-vis gold. I would tend to say you're looking at a similar case between like Bitcoin and Ethereum. I don't think either of them are going to go into a bear market, but I do think in this phase, if you're looking to profit in something, you're probably going to get more momentum and more juice out of Ethereum than Bitcoin.
That's a pretty good analogy, the gold silver versus the Bitcoin Ethereum analogy there. Well, we've talked about cryptocurrencies and we've talked about gold as an uncurrency. What about the US dollar? That brings us full circle back to the beginning of the discussion about looking forward to the rate cuts in September, Jerome Powell's speech in Jackson Hole. What do you think happens to the greenback moving forward?
Look, I don't think anything that the Trump administration is doing is bullish for the dollar. I think it's the exact opposite. I don't think that the interest rate outlook is necessarily really bullish for the dollar. It tends to be neutral to bearish. I think that, from a just sort of long-term store of value and money flow kind of perspective, you're going to continue to see money flow out of the dollar. What we've done from a fiscal, monetary, and pure politics side of things, everything we're doing is ultimately not positive for the dollar, in my opinion. So, you get a case like right now where the dollar is just stabilizing after a big sell-off. It's been bottomed out in late July, and here we are up a little bit, 98 and change on the dollar index. From a trading perspective, you might test 100 on an upside move on a counter trend bounce. But longer term, I don't see a lot of reason to be long the dollar. I see plenty of reasons to be short it, or at least long things that tend to do well when the dollar is declining. meaning commodities, meaning gold, meaning foreign stocks relative to U.S. equities. I think that part of the market, this equity market's been ignored and undervalued for a long time. So you're going to correct that. So yeah, the dollar to me, just there's not a lot I like about it. Let's put it that way.
So, Mike, I guess just to sum it all up, you're seeing a lot of bull markets out there. Fair enough. Would you say, though, that this is a good time to be well diversified? It almost sounds like you would recommend staying away from some of those high flying tech stocks, or at least limiting your exposure to those and spreading your money out to a whole lot of these other international markets, commodities, and sectors that have lagged these tech stocks.
Yeah, I mean that's a fair assessment there. I mean, I think, for every new incremental dollar that you're putting to work in the markets, you should be, in my opinion, putting more of it to work in other sectors and things like financials, industrials, maybe some yield plays, maybe some commodity plays vis-a-vis tech. I don't think that tech is going to collapse and fall apart or do anything like it did in 2021 or certainly in 2000 or 2001. But, I think the incremental performance is going to come from other parts of the market. And I think that that's probably a trend that isn't one day, 1 week, or 1 month. It's probably multi-quarter to potentially multi-year in the case of maybe foreign stocks versus U.S.
All right, there we have it. Mike Larson, editor-in-chief at Money Show. Click that link in the show notes to visit the Money Show website, learn about their upcoming conferences. Mike, always great having you on the show. I really find you breath of fresh air looking at these markets broadly, not getting too attached to any of these markets and understanding that there are opportunities in a wide range of markets. You just need to make sure that you're following where the money is flowing, especially in this rotation trade. Everyone, stick around. We're going to be right back, focusing a bit more on the energy sector.
Thanks, Corey. Take care.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. Now shifting our focus exclusively to the energy sectors. We're chatting with Dan Steffens. Dan is the president of the Energy Prospectus Group. And Dan, we're going to be talking nat gas prices that continue to drift lower, oil markets that continue to be pretty boring with what seems to be a bias to the downside, and a few companies with recently closed acquisitions that you see as good opportunities, even in this environment with slightly falling energy prices. I really want to start with natural gas. Natural gas has been falling pretty much all through July and now all through August. A lot of the data that I am seeing is saying that demand is okay, but supply just keeps outpacing demand. Curious to see what you're seeing in the nat gas market and why the weakness, again, in the last month and a half is still continuing.
Well, you guys are up there in Vancouver, so you don't know what a hot summer's like. Anyway, so last July, the previous July, we had like 18 days over 100 in July. It was hot. It wasn't never rained, a couple of rain. This year, I don't think July we had 1 day over 100. If it was just for a couple hours or something. But we've been getting pretty consistent rain all the way through January or through July and August. I mean, it's like every other day we're having thunderstorms, and that keeps it cooler than normal. So that's lowered, electricity demand for your air conditioners. But anyway, so the thing to remember is we have two peak periods of demand. There's one in the summer and there's one in the winter. The one in the summer is for electricity demand. But so whenever you have storage builds, bigger than normal, or draws, smaller than normal in the winter, you're going to get an impact on the gas price during those peak demand periods. And that's what you have. And so what that does is that impacts the front of the curve. And so the price you see is the front month NYMEX contract, which happens to be September. So right now we have storage of like almost 200 BCF above the 5-year average, which sounds like a lot, but it's, storage holds over 4.2 trillion capacity. And so if you have at this time of the year, when you're just a few months away from the starting of the winter, if you're above normal in storage, then the utility companies don't want to take physical supply because they have to pay storage fees on it. So you don't have them buy it. And on the reverse of that, some of the biggest price spikes ever in the last 25 years, the biggest price spikes have happened in the summer months in the third quarter. And because that's when they feel they don't have enough gas in storage, and then you'll get a bidding war for physical supply in the NYMEX contract. But when you look at the fundamentals for the future of gas, especially in the next 18 months even, it looks very bullish for natural gas. In fact, EIA, in their short-term energy outlook Steno report for August, which came out about 10 days ago or so, they are saying their forecast is that natural gas will be $5.40 per MMBTU by December of 2026. So that's what, 15, 18 months away. And the reason why is because you got all these LNG export facilities coming online. Like I'm looking at a chart right now that's from Range Resources, has some really good slides on there. And LNG exports are supposed to ramp up over the next 5 years by 13 BCF a day. So they're going to go from about 15, BCF a day to 27, 28 BCF a day by 2030. And in addition to that, you've got exports by pipeline to Mexico going up. Which is going into their LNG export facility. And then you've got demand for electricity by these AI data centers that's really going to start ramping up when we get near the end of 2026. A lot of the AI data centers are actually being built in the basins themselves because they don't trust the grid. So they're going to set up their own natural gas fired power plants. But the demand, we got to add at least, and then another thing is, you got to remember that all oil wells, all natural gas wells are all always declining. So it's not like the gas wells that are producing today, 5 years from now, will not be producing nearly as much gas. So not only do you have to find the gas to fill the gap of 20 BCF increase in demand, you've got to replace the gas of the declining wells itself. So you got to spend a lot more money drilling more wells, more infrastructure, and stuff like that. But the main reason it's going to be really difficult to meet the demand by the end of 2026 is because of lack of infrastructure. The pipelines are pretty much full. The reason that gas prices are so low in the Permian Basin is there's no pipeline capacity left. And so, they don't have any leverage because their pipes are all full. And then the only area that really has a lot of upside near term and can get gas to the LNG exporters along the Gulf is the Haynesville. And that's in South Louisiana, East Texas is the Haynesville. And those wells come on really strong, but they've got direct access to some of those big LNG export facilities. So anyway, it's just but right now the price is down because the storage is higher than normal.
So Dan, I want to follow up quickly on that nat gas data, what the EIA had to say, because look, in the long term, fine, 18 months out, prices might be a whole lot higher, but when could the trend change? Because a lot of the data that I saw in that report is that they say demand remained decent, up 1.3% year over year in the US, but they're also estimating that demand growth could turn negative in early 2026. So let's say 6 months out. And they also pointed to the supply side where U.S. gas rigs are up 25% year over year. And there's typically a lag between rig counts when those move higher and nat gas production when that moves higher. So if we're trying to time this market for a good entry into either buying nat gas or buying any of the companies, it's nice to not buy when the market is still falling. So is this a story where we need to revisit it in early 2026, where the data, it seems like from the EIA saying, could get even worse before a turn in the market? So maybe the stocks follow the market lower until that time?
Well, right now you're looking at the front month contract is September. So I think when we get to the end of the month, the end of August, we'll go to the October deal. And so see, if you're the owner, the long on a September contract and you hold to the end, you have to take physical supply of that gas and you're going to start getting billed for storage fees. But as we get closer to the winter and October, November, December become the front months, then you don't care because it'll go right into the market. I mean, then when you get to the mid-November, demand for gas is going to exceed supply and the storage is going to start going down. So you're going to have rising prices at the front of the strip as you just get closer to December. And then I think the January is already in the high threes. It's close to $4 right now. It was over $5. So I think the prices will just start inching up, just seasonally inch up anyway. And then it's all up to the, what's the winter weather like? If you have a cold December, 200 BCF more or less in storage can be totally wiped out in 1 week in a cold week in the winter. I mean, we have storage draws that are like, there's been storage draws of 300 BCF in a week. So that excess is not that much. Now, if we have another really mild winter like we had, not the last one with the previous one to that, yeah, that could be a problem. But if we just have a normal winter, everything's going to kind of take care of itself. And we do have, there's several big LNG export facilities coming online here. Golden Pass is going to ramp up. It's a big one. Plaquemines is going to double up here pretty soon. I think just in the last few months, we're going to add like 3.5 BCF per day of export capacities because we're going to be up to 20 BCF per day pretty quick. Anyway.
Well, all right, Dan. So I guess in summary, in the short term, not a lot of impetus for the gas price to go higher. But when you look out 18 months to next winter, you have a confluence of events from the demand from AI data centers starting to come on with the nat gas plants. You've got the LNG terminals. You've got declining rates that'll not be as strong next year as this year in the nat gas sector. And then you also have the infrastructure limitations as far as not being able to ramp up fast enough. So looking at higher gas prices a little further afield, but maybe not so exciting in the near term. Let's shift over to oil, though. Oil's been pretty boring and range bound with a slight bias to the downside. Do you think that geopolitics is playing in here? Do you think it's more of a trying to keep the fuel prices low for inflation? How do you read the oil market and the weakness we've seen, Dan?
I truly think there's a lot of political forces at play doing all they can to keep the transportation fuel prices down because the Wall Street gang and the Trump team, they want the Fed to lower interest rates. And the Fed's only going to lower interest rates if they believe that inflation is not a threat, if that inflation is under control. Well, the only way you can really control inflation is to keep transportation fuels low for as long as you can. So they're talking it down. And then you've got IEA and EIA putting out these forecasts of why they think, oil could dip below 50. And I'll tell you one thing, if oil prices drop below 50 for any length of time, you will see the upstream companies just absolutely slam the brakes on their drilling programs. They'll just shut down and they're not going to keep drilling these high rate wells that come on real strong and then want to produce that flush production up front into cheap gas oil prices. So they won't. And, even these guys like Diamondback, so much of their really good tier one acreage is all held by production already. So they don't have lease expirations as a gun to their head to have to drill a bunch of wells. So, but anyway, I think, there's no glut at all. Just the report that came out on Wednesday from EIA, our U.S. crude oil inventories are 6% below normal. U.S. distillate inventories, which are diesel, which is a big transportation fuel, is down 13%. The refineries are running at close to 97% capacity. I can't remember seeing them that high ever, hardly. And it's because, refining margins are really high. The refiners should be doing really well because diesel prices stay high because there's diesel shortages all over the place. And then what the big geopolitical question right now is, what the hell's going to happen with the Ukraine war? Personally, I can't see that war ending like this weekend or anything. But then what's Trump going to do? Will he then agree to drop all sanctions against the Russian oil? And then will that even make a big difference? Because everybody knows that China and India are buying every dollar of cheap Russian oil they could possibly get. So I don't really see, even if you drop the sanctions, is a bunch of new Russian oil going to hit the market? And, their infrastructure has been damaged during the war because I think Ukraine's been able to get drone attacks on some of their infrastructure over there. So I don't see that really being that big of an issue. But now if Putin, is just playing around and he's not serious about ending the war, then I do think Trump's going to put secondary sanctions on, especially India. and tell them, okay, if you don't stop buying Russian oil, we're going to jack up your tariffs to 50 or 60% or something, then they're going to have to. And then that would cause a big spike up in oil prices, I think. So, just a lot of geopolitical forces right now. But as far as supply and demand, there's no glut of oil and petroleum products anywhere in the world that we see yet. There's a lot of talk about the OPEC Plus raising their quotas. Remember, they raised their quotas. They didn't raise their production that much. A lot of the OPEC countries can't produce up to their quotas anyway. The only country with significant supply potential increase is Saudi Arabia.
Dan, I appreciate you breaking down the macro forces for both the nat gas and the oil markets. Let's pivot over to some of the energy companies, though. I know a lot of people listening appreciate getting your thoughts on the individual stocks, and we got a couple different companies to discuss that have had, I guess, transformative acquisitions. And one of the companies we actually just had on the show earlier in the week was Inplay Oil, traded on the TSX under the ticker IPO and on the OTCQX under the ticker IPOOF. And we had Doug Bartoli on, the president and CEO of Inplay, and we were discussing how they were already a solid company in the Pembina area of Alberta before the acquisition, but since they picked up these properties from Obsidian, they've really hit the gas pedal, no pun intended. So walk us through the value proposition for Inplay Oil.
Well, first, let me say I do own the stock. I have about 7,000 shares of Inplay. I have been investing with Doug Bartoli and his team for over 15 years. I was back, I can't remember the other company before that, but this is like the third or fourth go around for that team with public companies, and the other ones they sold at pretty big gains. But I will tell you, I've never seen Doug this bullish about where he stands right now. He feels very, very good about the deal. And obviously, with their second quarter results coming in way above their guidance, that was great. The thing that really caught my eye in this, so when they took over the property, there was like 7 wells that had been drilled that hadn't been completed, and the Inplay guys completed those wells. 2 of those wells are in the top 3 best wells in the entire Pembina play, which is hundreds of wells. Okay. And those wells paid out, when oil was averaging maybe like 65, they paid out in 90 days. These are like $3 million wells that paid out in like 90 days. And on the average Pembina Cardium well, horizontal well, I think he's doing 1.5 mile laterals, some 2 mile long laterals. Those 1.5 mile laterals, according to the average type curve of how they come on and what rates they come on at, $65 oil, they pay out in 1.5 years anyway, which is incredible. I mean, that's your turn in your, your rate of return then is really because they don't just stop producing at 1.5 years. They're still producing pretty strong at 1.5 years. So you get a lot of profit off of that. Well, so it looks really good. I mean, the stock closed, it's up since he announced the second quarter results. The stock has gotten a lot of attention, but just the acquisition itself brought a lot of attention to it. And it's up 11.6% year to date as of the August 19th close, but it's still well below the 52-week high. And I'll tell you, the company's in much, much better shape than when it hit that high. So my current valuation is $18 a stock, Canadian per share. And it pays monthly dividends of 9 cents Canadian. That's $1.08 Canadian per year. That annualized yield then is 9.8%. You can tell if you go look at their recent presentation, everything, he definitely is going to keep paying those dividends, wants to. I mean, there's never any guarantee on dividends, but I mean, obviously if oil price went to 40 or something, he'd stop paying dividends. But everything looks like they're going to keep paying those monthly dividends, which I like. The stock I've owned this stock for like 10 years, and it's been in our high yield growth portfolio for a long time. And it wasn't paying dividends. So then when he started paying dividends, the price went way up, and it's been a really good stock for us to own. And just going, but so you get high dividend yield, but I think there's a huge upside in it. Now, the big thing is with this one is the news that Delek Group bought the seller of those assets got some stock, and they sold all their stock to the Delek Group. And if you're not familiar, if your listeners have just Googled Delek Group Limited, and you'll see how big of a company this is. but they own 32.7% of the common stock of Inplay now. And I cannot emphasize how important it is to have a investor of that quality, because they don't invest in these companies unless they really see the upside to them, and also they are going to support their growth, and they have a very strong track record of taking their investments and maximizing those companies and building shareholder wealth. So I think that's a big deal. But Inplay all by itself, they don't even have to make any more acquisitions. They have a tremendous amount of running room. They have over 400 horizontal developed drilling locations in the Cardium zone within that Pembina play. And where's it? They have another one. I can't think of it right now. But anyway, they just got a lot of running room, and it's in their core areas. They know that area. It isn't like they're going into a brand new area, and they already have operations in there. So they're gonna get a lot of savings on synergies because they didn't have to add a bunch of people. I think when you interviewed him, he made a big point of that. And anyway, the outlook looks good. And if those next 5 wells are really good, their fourth quarter results going to be way above what their current forecast is, their production forecast is.
So, Dan, I'm curious on the valuation here, because your valuation, $18 per share, stock right around, let's say, $11. Current market cap, $305 million. The Q2 results were a little over 20,000 BOE a day. The company's forecasting Q3 and Q4 right around 20,000 BOE a day, slightly under that. And Doug was on the show saying that the company's very focused on paying back debt right now. They don't have a huge drill program. I think it was net 5.5 wells that they're planning for the rest of this year. And he really focused on growth through M&A in the future. So with your valuation target of $18, when does that kick in, and what other companies can we compare Inplay to that are right around, at least for this year, 20,000 BOE a day, and what's their market caps?
Well, my valuation is only 4 times 2025 and 2026, my forecast of operating cash flow. They're going to generate over $4 operating cash flow this year, $4 per share, actually $104 million, $105 million of that compares to his CapEx budget is only 56. So he's generating a ton of free cash flow. Let me tell you something about Doug, and I've known him for a long time. He hates debt. He is not going to go out there and try to build this company by, he wants to really pay this debt down. And so I think they're going to drill these 5 wells. Then I don't really see them doing much until after spring breakup in 2026. And then just depending, if the oil price kind of gets back and it firms up above 65 or something, I think he'll get pretty active drilling a lot more wells. But, during these periods, there surely is going to be a lot of M&A opportunity for them. And especially if in their core areas, if they can, fill in some open acreage there and stuff like that. But he really doesn't have to. But I think that's a quicker way to build the base of the company. And I think Delic's going to have a couple seats on the board, and they're probably going to have a lot to say with what they do. But if they're going to really back this company financially, they could go really fast. So we'll see.
Yeah, it's going to be interesting to see if Inplay Oil goes out there on the acquisition front and keeps pressing the gas pedal, and if Delek, like you say, being on the board and coming in as a strategic partner, if they encourage them to maybe grow more through acquisition than even through the drill bit. So we will see how it goes, but definitely a strong company setting up for a strong year, but also a strong next year. And sticking with the theme of strong M&A, let's talk about another company on the list here, Dan, and that's Riley Exploration Permian, traded on the NYSE under the ticker REPX. They had a transformative acquisition themselves that just closed on July the 1st this summer of Silverback, and that added in a big part of oil production to the mix and also made them a stronger company. A lot of these companies, when they do the M&A, the first quarter or two, the market's not properly valuing in how strong they've just become pro forma. So walk us through the value proposition in Riley Exploration Permian.
Yeah, we added Riley Exploration Permian to our small cap growth portfolio 7 years ago, and now it has moved in. Well, it still is. It's my number one pick for growth and income in the small cap growth portfolio. They're a bigger company from a production standpoint, but by year end, they're going to be about 40,000 BOE per day of production. But the silverback, we just saw Inplay had a big jump in its share price when they announced the first full quarter after their acquisition. Well, Riley's going to be the same way when they announce their third quarter results. It's going to be the first full quarter. And they've also had some weather-related issues. Their production was down a little bit. So they're going to announce a big increase in their production from the second quarter to the third quarter, probably about 5,800 barrels a day, with 2,300 barrels of oil per day from second quarter to the third quarter. So going to about, I think, 35,000. Now, but by year end, they're going to be at 40,000 BOE per day. So pretty decent company. Now, the thing is, where they are in West Texas, they're out there in very West Texas and in New Mexico. They got two core areas. One's in Texas. It's right on the New Mexico border. And the other one is actually in New Mexico. And that's their recently acquired. They did a Pecos acquisition. And then just recently, the Silverback bolted right onto that. That acreage is like right mixed in with the acreage they already had. So it gives them a bunch of running room in there. They're really excited about it. And it looks like more than 100 low-risk horizontal drilling locations. The only, kind of negative I had on the company was I didn't see it had a lot of running room. Well, now it does. Now it's got a lot of running room. And, running room, if it's in the middle of nowhere, doesn't mean much. But when you have a whole bunch of development drilling locations, this is the same true for Inplay. A whole bunch of development in an area that you're already operating in. You don't have to add a lot of people. You don't have to open new offices or anything. You already have your people there and your infrastructure there. That's the best kind of development drilling inventory you want to have. And so they got it in. And this company, for some reason, its size, it just doesn't get hardly any analyst coverage. There's only like 2 or 3 analysts that cover this thing. And you got a company here pushing 40,000 BOE per day of production and doesn't get much coverage. It's kind of weird. But we like it. Pays a nice dividend. It's like 5.7% dividend yield right now. I see no reason they're going to cut the dividend, and they're going to have a very, very strong third quarter results to tell the market. So,
Dan, to be honest with you, comparing this to Inplay, looking at its production profile, okay, double the production profile, but its market cap right now is already 600 million US. So it's a much higher, more than double the market cap of Inplay. It pays a lower dividend, about just under 6%. So do you just see the growth is driving this much higher? Because your current valuation I'm seeing of around $48, this pushes it into a drastically different company, or drastically different world than Inplay with double the production. Fine, but that would be triple the market cap.
Yeah, and it's a very profitable company. Right now, I would say I like Inplay better. I'm just saying from a timing standpoint, I think when they announce their third quarter results, it's going to get a nice pop, especially if oil prices rebound. The thing is out there too that the gas prices are so terrible out in their part of the Permian because they don't have enough pipeline access. They actually have a power business. They're building their own gas-fired power plant using their produced gas that was selling for like 50 cents. They're going to now turn it into electricity to run their pumps and eventually make enough electricity to sell into the grid. And I kind of like that deal. Now they have a lot fewer shares. They only have 22 million shares of stock. So the per share results, I mean, this is how probable it's been. In 2022, their reported net income, $5.85. Then it went to $5.47 the next year, $4.14 in 2023, and now $4.71. First Call's net income per share forecast is $5. A very, very profitable company and generating $9 to $10 of operating cash flow. But their strong production growth in 2022, 33% year-over-year production growth. Then the Pecos acquisition, 61% year-over-year production growth. Then 21%, pretty much with the drill bit. 21.5% this year plus the acquisition Silverback, and just on a very conservative production forecast for 2026, they'll have another 16% production growth. So, during this whole time, they've been paying pretty good dividends. So it's not like they're just plowing all the money back into the ground for growth. Their shareholders are getting, nice returns and getting growth, and their per share production just keeps going up, and that should be the driver of the share price.
Well, Dan, one other company that's also done a transformative transaction and is also growing on a per share basis, so same kind of theme as the other two here, is we saw just this week the combination of Viper Energy and Sitio Royalties. We've talked about both those companies with you in the past, and Viper Energy traded on the NASDAQ under the ticker VNOM. They're a subsidiary of Diamondback Energy, which we've also talked to you about a couple of times. They're traded on the NASDAQ under the ticker FANG, so you got that snake theme there between the two companies. But with Sitio, they're not related to Diamondback in any way. So Viper is bringing in all of their royalties and mineral products, and they've revised their third quarter guidance now. But this looks like a company that's continued to be in a weak position along with the oil price, even though they're building more and more value underneath the surface and they've got strong operators. So be curious to get your thoughts on these two companies tying the knot just this last week.
Yeah, I love this deal. I did own both companies. So I owned Sitio STR that deal just closed on the 19th. So it's just getting closed, but everybody, these were two big publicly traded minerals companies, and they're just minerals and royalties. So they have no drilling risk. So these companies deserve to trade at much higher multiples than the operating companies that do have drilling risk. Now they do have commodity price risk, but they've gone from, in 2022, Viper's production was 33,600 BOE per day. Their production today is about 125,000 BOE per day. Their oil production, 66,000 BOE per day. I love this company. And this to me is a must-own company for any hedge fund, any mutual fund that considers itself a growth and income fund. They're not going to find a better company than this. And like I said, Riley and even Inplay to some extent doesn't have all that much analyst coverage. This one has all the analysts covered it, and they love this company. These days, it's almost impossible to find an upstream energy oil and gas company that has 100% of the analysts has a buy or strong buy recommendation on the company. And that's the case for Viper. They love the company. And it's the relationship with Diamondback, because Diamondback is an aggressive driller. They have a lot of their rigs running on minerals that are owned by Viper already. And now with the Sitio merger, there's going to be even more of them doing that. So that locks in production growth year after year after year. I mean, they're running like a dozen rigs on their minerals. So they're completing, wells every month, adding more production to Viper. So just continuous growth. Now, the one thing I do like about it, I think should get a pop here. They said they're now paying out 75% of their operating cash flow or distributable cash flow, and they don't really have any CapEx requirements. So their operating cash flow is like 90% free cash flow. And so they're paying out 75% of that, the other 25% to pay down debt. Now, when they get their debt down to their goal, which it should happen in the next year, then they're going to be paying out 100% of their distributed cash flow in the form of dividends. They pay a fixed dividend and a variable dividend. The last one was 53 cents. Due to this merger, I think the quarterly dividend is going to go over 70 cents. So that's going to increase their yield. And they're going to have a really, really strong balance sheet at the end of the year. I mean, this company's super strong. And only about 40% of their minerals are actually developed. So they have got a ton of running room in just what they own. And because of their size and their access to capital, they're the go-to buyer for if anybody or a family or something out there wants to sell their minerals, they're going to check in with Viper to see what kind of deal they can get. And they've got teams out there kind of looking to buy minerals all the time. So they're continuing to grow. Now, Sitio does own, Viper's been pretty much a Permian Basin company. Sitio owns a lot of acreage outside of the Permian, minerals outside of the Permian. So maybe they'll sell off some of that stuff and use that money to pay down the debt faster. But the sooner they get their debt down to their goal, and I think it's $1.5 billion in debt. When they get that low, then they're going to pay out 100%. So that'll be a nice dividend pop here probably next year.
Dan, any idea why the stock has dropped so much since December? It's down about 35%.
Yeah, just the oil price being down. It's heavily weighted to oil. even though their production mix is like 52% oil, 26% natural gas, and 22% NGLs, 85-90% of their revenue is oil sales. So with the oil price being down, and there's been some confusion with the deal, but when was it going to close and everything? And I don't know, the Wall Street gang always, when they look at these deals, until they actually see a full quarter of results, they kind of assume that these guys always overpay. There's no way these guys overpaid for anything. They're too strong. And, they have access to all the research guys over at Diamondback too. So, it's kind of like Diamondback really runs this company.
Okay. Hey, Dan, always insightful looking at the energy sector, even as it is in a bit of a downtrend right now. But you've given us food for thought of why that might rebound or correct itself really in the near term, but especially into next year. And number of companies, still a lot of M&A happening in the sector. It's something to watch as more quarterly reports come out, especially through Q3, and potential still revaluations in a lot of these stocks. Everyone, that wraps up this weekend show. Hope you enjoyed this weekend show, and very thankful that you took some time out of your weekend to join us on the KE Report. Please go back through our website, podcast, YouTube channel, and Substack account. Just search the KE Report. We add a lot of company updates from throughout the week, as well as some market commentary covering some of the day-to-day moves of markets that have slowed down a little bit, but it is the end of summer. Get ready for everyone to get back at their desk in really just a couple of weeks' time. Dan, thanks for your time, and everyone, again, thanks for tuning in with us this weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.